right, it looks like it's 5:31. And Clayton Quamme. I've met a few of you guys I see popping on here. We got a few of us also on the call from the AP Wealth Management team. You'll see Millie there and Jean's hopping on and Sharon's there. If everyone can hear me, can you just give me a thumbs up for those that are on the video so I can make sure y'all can hear? I'm seeing a couple thumbs come up. All right, I'm gonna let Millie jump in real quick and just give us some basic info on if you have any issues tonight on the call, what you can do to get help.
Yes, thank you, Clayton. Hey all.
Hey Millie, I can't hear you.
Oh.
Be on mute.
How about that? Is that better? Can you hear me? Okay. Hey y'all. So if you have any issues, please give us a call in the office. Sharon is manning the phone system and can help you guys if you have any technical issues. And if you want to submit questions, if you'll scroll down to your toolbar at the bottom of the screen and click chat, and you can send us questions that way, and we'll get to those as soon as we can.
All right, thanks Millie.
Welcome.
I hope everyone's been having a good week so far. I know it's been a couple months since we've done the briefing, so we're excited to be back with you guys today. The goal tonight is going to be just to review some of the info that came out of our recent investment committee meeting that we had actually last week, and just to give you a basic update. And then we also wanted to spend a little bit of time diving into elections. We have been getting a lot of questions about the November election coming up, and just going to talk a little bit about our thoughts around that and just how we are kind of viewing things over the next 90 days, which is kind of crazy. We're less than 90 days away from an election. So we'll go ahead and jump in here. If anyone can't see slides, just let me know. You guys have all seen this slide before. This is our investment strategy slide, which I'm going to go into more detail here in a later slide, but just as a reminder to everyone, you know, this is how we view investments with asset allocator. We're asset allocators first, that's like the pie chart you've seen. You know, when we sit down, we talk about the pie chart that's got large cap and small cap and mid cap and international. That's asset allocation, and that's, you know, the very first big decision that we're helping with. And that's getting that right, honestly, is really one of the biggest things we will do, and to make sure that you're set up to reach all your long-term goals. So asset allocators first, but then, you know, underneath that, there's a lot of decisions that go into how do you build out that asset allocation? What's your portfolio look like? What types of accounts do you have, and what types of investments are you using inside those accounts? So nothing's changed, by the way. It's all still the same as far as our overall philosophy. Same thing here. This is that total return, and as you all know, we're focused on total return. So this isn't just about trying to find good assets that are going to provide capital appreciation, but we're also trying to find assets that will provide income as well. So there's both sides of the coin, and both those equal total return. And that's really the overall goal, is to make sure we're maximizing total returns. All right, we're going to bring out Warren Buffett here to kick things off. This is a quote from Warren, and I think it's very, very timely as far as what's going on right now and just what we're looking at. And so it says, to invest successfully over a lifetime does not require stratospheric IQ, unusual business insights, or inside information. What's needed is a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. You must supply the emotional discipline. And tonight, I think what we're going to go ahead is unpack what we use as our sound intellectual framework for making decisions. And then we're also going to unpack some of the emotional side of things, which everyone is experiencing right now on a very high level. So what is AP Wealth's sound intellectual framework? How does that work? We talked a lot about it on previous calls. It really is our investment committee process. And it's the process that the AP Wealth team uses to make our investment decisions for each client. And I think everyone knows, but just it would be very helpful to do a review of how that process works, what it looks like inside the office. And that's really what we're doing here, is pulling back the curtains and giving you an idea of what happens there. So, every month, the investment committee, which is really made up of most of the AP Wealth team, sits down in the big main conference room, and we spend a couple hours diving into the weeds and trying to unpack what's going on and distilling down all the information that's coming at everyone from all these different places, and coming down to what is the key factors that we need to be looking at. And based on things that have taken place over the last month or two, do we need to make any tweaks or changes? And that's a monthly process that we have. We've got a meeting that happens with the committee, and then from there, depending on if we decide to make any tweaks or changes or feel like we want to do something different, that's then translated into changes in clients' portfolios. So I'm going to talk a little bit how that works. So what do we discuss? Well, we discuss all sorts of things. We have actually an agenda that we've come up with that goes over, and kind of guides our conversation, but most of the discussion is around what's happening out there. We talk about unemployment rates, we talk about inflation, we talk about interest rates, we look at tax rates or any changes, we look at PE ratios. So we're unpacking a lot of big global information, and have a lot of discussion around that. And then from there, we talk about individual holdings or funds that we have. Are these funds still funds that we feel good about holding from a long-term approach? Do we need to make any tweaks or changes? And really, there's two main changes or things that we can tweak inside of the portfolio. And I want to talk a little about what drives those tweaks or changes. That's what we get to investment committee. We say, hey, do we need to make any changes? And when we say that, well, what do we mean by what changes we make? Well, the first would be overall asset allocation changes. So when we talk about these asset classes and the pie charts we're talking about, that's again, large cap, small cap, mid cap, international, those big asset classes. We sit down as a group, and you'll also hear them referred to as the opportunistic, the protect, those asset classes. Well, we say, hey, do we need to hold more or less large cap stocks or mid cap stocks based on things that are taking place right now? Should we hold more or less fixed income? Should we hold more or less cash? And those decisions to hold more or less are typically going to be driven by the big global economic data and factors that we're looking at. So when we sit down, we talk about what is happening with unemployment, what's happening with interest rates. Those things are what's driving our discussions around, do we make any big sweeping changes? And you will notice, that there are tweaks and changes that happen over time, but they're not going to happen every month. So these are more gradual changes. And then the next thing we talk through, once we talk through those, is we say, well, what of the holdings that we're holding, do we need to do anything different there? Mutual funds, ETFs. And so if we feel like our active mutual fund isn't doing well, we might want to replace it with a passive mutual fund. And that's the other tweak we might make. So in your portfolios, the way that works is rebalancing. When we go and we rebalance, that's how we would make those big changes that we've discussed and thought about in the investment committee meeting. And same thing with individual funds. If we feel like we need to sell some or buy some, then you'd see the tweaks translate into your customized portfolio. I think one of the really big takeaways that we've learned over the past, few years of doing this is that sometimes, the best decisions or the best things that we're deciding on or talking on or figuring out is not what to invest in, but actually what should we avoid? And I was recently talking with some folks that, other advisors across the country in a peer group that I've joined, and I felt pretty good about what we're doing at AP Wealth, because a lot of them were just venting, as advisors do and peers do, about their investment performance. Their investment performance had been actually lagging this year, especially because they've done some things inside their portfolios that have not played out well. One of those is actually international investments. So if you look at international investments, a lot of folks have said, hey, it might make sense to overweight international investments because their PE ratios are lower and they pay higher dividends. And here at AP Wealth, we've actually chosen to underweight international investments. And because of that, our clients and our portfolios have reaped the rewards. And so this year's turned out to be a good year. A lot of folks are actually positive and have made returns, where a lot of these other advisors and firms have said, we're negative, and we've been negative for a while, and they're trying to, figure out how to get things back on track. So I think some of it is not, what we're buying, but it's actually what we're avoiding and underweighting. And this slide kind of talks through very similar things to what we talked about last time, but the investment committee still feels that, we would favor an overweight in U.S. equities over international. We're also overweight cash over bonds. Interest rates are really low right now. Looks like they're going to continue to remain low, and because of that, we're still holding on to more cash than we typically would. A quality over yield with bonds, very similar trend there. If we're going to own bonds, we want to hold quality bonds. And finally, we don't think inflation is going to be a problem in the near term, but long term it may be. So we're keeping a really close eye on inflation. And if we do see it start to kick up, we definitely would probably start making some tweaks. So that's just a brief update from the investment committee meeting and some of the things that we've been watching. I think that really a lot of this uncertainty and unknown spills over into election. And just like that quote we were talking about there before, often the best decision is not what to invest in, but what we should avoid. Coming into this election, it's very similar. What we are doing in preparation for the election is sometimes not about taking action, but it's actually about making sure that we feel good about where we are and we're rebalanced. And I'll remember that Warren Buffett quote that we talked about at the beginning. He says, "What's needed is a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. We must supply the emotional discipline." And with the elections, I think that's what's really creating all these questions, is all the emotions that are taking place. And 2020 has already been such a huge year for a lot of emotions. Coronavirus has created so much uncertainty in our lives. For a lot of us, it feels like things have just been flipped upside down. The way we go about things, in a lot of ways, no longer similar, just trying to do basic things, going out to eat, going to visit friends, getting together with family, planning weddings, planning any kind of big events. It's a lot of tough emotions that are around that. And now here we find ourselves staring down the pipe into an election in 9 days. And those same emotions that we've been experiencing just from the coronavirus also are spilling over now into elections. And when we have a lot of emotions going through us, the natural reaction is to actually want to try and protect and potentially do something defensive and take action in a way that would be like a big shift in what you're doing. But as I'll show you here in a second, the data that we've looked at, and this is just the data that we look at from the investment committee meeting, we can't see anything, we haven't found anything that makes us say we need to make a big wholesale shift or do something drastically different. What we do say is that we should probably be rebalancing and making sure that everyone's, which is what we typically do anyway. So before I jump into the data, I stole a chart from my daughter's first grade teacher. She had the motion word chart up here, but just take a second. I'm going to read through these. I just want you to take a second and think about the current emotions that you've been going through with coronavirus and even these upcoming elections. I mean, the emotions that you guys have been experiencing. In that first line, we got anxious, miserable, nervous, bored, happy, surprised. I know for me, anxious and nervous. I mean, who knows what's going to take place? Who knows what outcomes of this is going to be? Who knows when coronavirus is going to happen? The next line, you got fear, sad, confused, skeptical, unsure, encouraged. A lot of the negative emotions, are things that folks experience as they're looking at the election. Skeptical. I mean, I think a lot of folks are skeptical of what the promises that are being said right now and the way things are being framed on both sides from both different parties. Next line, hesitant, perplexed, stunned, glad, pessimistic, and upset. Stunned one sticks out to me on that line. I don't think anyone's not been stunned by just what 2020 has had in store so far for us, and creates anxiety when those events happen. Delighted, interested, angry, afraid, joyful, and tense. I think tense is something we've just been seeing in a lot of folks. They feel very tense right now. And then shy, loving, annoyed, and curious. When I think about those, I'm like, man, it's crazy the amount of emotions that I've really gone through. I've probably almost experienced every single one of those at some point during the year. But going into the elections, important to be aware of what you're experiencing, and that's when you're having a lot of the emotions, like the nervous and the anxious and the skeptical, afraid. That really does drive this feeling of how do I protect my money? How do we make sure we're doing something that that we're going to make sure that if it crashes or something negative happens, that it's still there. And we've already built that into the equation, is the way I would look at that. When we've sat down and done your risk assessments, we've asked you a lot of the questions about what you got coming up. It's all that goes into that asset allocation that we talked about. And we built the asset allocation to make sure that when we're experiencing emotions like this, that we know that it's going to do what it needs to, and your money is going to help you accomplish your goals, and it's going to be protected, because none of any of our clients are 100% stocks. So let's dive into the data a little bit and the reasons that we're not making any big changes given the elections. And just this first slide shows the annual S&P performance based on partisan control. So you can look here, it's got 6 different bar charts, and the bottom, it tells you who's controlling what. So like that very first bar chart says it was a Democratic Congress and a Republican president. The next one's the Democratic Congress, Democrat president, and so on and so forth. So the big takeaways when you step back and you look at this, they're all positive. Every single one of those is positive, and those last 4 are almost equally positive. And really in every single scenario, the market still continued to move forward, and it's still continued to go higher. Companies are still figuring out how to make money and how to be profitable. And there's not a single one that says, hey, we need to, if this political or partisan control scenario happens, we're screwed. And I'll tell you a few facts that were in the footnotes on this chart around that very first bar chart, the one that says 4.9% under a Democratic Congress and a Republican president. In that period, again, this is looking from 1933 to 2019. So the events that have taken place when we've had a Democratic controlled Congress and a Republican as the president are the following. So you've got, it included the 1973 and 1974 oil crisis and the 2008 Great Recession, 2 of the worst crises in market history, as well as the 1958 and 1990 recessions. So If you just pull out the 2008 recession from that column, from the very first column, that 4.9% goes all the way up to 7%. And so some of it really is just random timing when, and as far as who's in control when certain recessions hit. And that's the reason that that bar chart specifically is a little lower, but overall most of them are similar. And again, they're all positive. And so when we're looking at this as investment committee, it's hard for us to say that no matter what the political outcome is, we need to run for the hills or make wholesale changes to a portfolio. The next chart is just it shows an average, the average return the 12 months following the presidential election. So after election day, essentially. And almost the exact same trend here. I mean, this is only a 1-year snapshot, and in a one year periods, you can have negative returns or positive returns, but overall, on average, whether the incumbent won or the incumbent lost, after 12 months, both, it's higher in both times. And if you look, these charts zigzag, they go, they cross each other multiple times throughout that year. So there's not even a rhyme or reason where one takes off and continues higher and ends higher. I mean, at any point during the year, whether the incumbent won or the incumbent lost, we could be higher or lower than where we started. And then these are just, the averages. So there's no, political party and who's in control. That's really hard to make a determination on exactly what that's going to do to the market, but mainly because, the market doesn't run off of what political parties are in control. It runs off of fundamentals and valuations. So, just to kind of summarize some of that, are there any adjustments to portfolios based on upcoming election? As far as wholesale changes go, our answer is no. We're not making any wholesale changes or doing anything big. But as far as rebalancing goes, the answer is yes, absolutely. Are we looking at portfolios? And that's a constant ongoing process, but we're definitely rebalancing and making sure that, especially with this recent, this year's been kind of crazy with, a big 30% drop and now a big gain. And so those are definitely times to make sure that our allocations haven't gotten out of whack. There's just too many unknowns as far as who's going to control the Senate, the House, and the White House, and what policy changes will be made. I do want to make, there's a couple other points that I thought about when I was thinking through this. One is the Fed chairman. When I think about big changes that could influence our decisions for investment changes, if the president signs a bill that's a sweeping tax law change, like what happened in 2017, where all of a sudden corporate tax rates went down significantly. Well, we saw the market actually react to that when the bill was signed and the bill was getting close to being signed. That's when the market reacts to those things. And we were at a spot where we, ready to make adjustments as needed. But it was a good thing because corporate tax rates went down, which gave the profits a boost to corporations. So that's something that Congress can do. And that's an area where we actually would be watching. But that doesn't happen with elections. That's after the election. And that's a policy change that takes place. The second part is beyond Congress, the other really big person that can impact markets is the Fed. The Fed can have an even bigger impact on markets than sometimes Congress and the White House can by even just a sweeping tax reform bill, just by moving interest rates up and down. But I'll tell you, if you think about it, when a new Fed chairman is appointed, we don't make big sweeping changes in our portfolios or our asset allocations. When Ben Bernanke or Jerome Powell or Janet Yellen or Alan Greenspan were all appointed, everyone wasn't running around making changes because that's not what changes the markets. Now, when when Jerome Powell gets done with the meeting and he goes and he provides feedback on the economy and on the direction of interest rates and on where things are going, well, then everyone does listen and everyone does sit down and consider, do we need to make some changes? So again, it's more based on the actions that the Fed takes or the actions that Congress and the White House takes versus the actual election and the actual appointment of the people that will be in those seats. And so that's what we're watching. And so I don't think we're not trying to say that you won't ever make a change based on something political. But what we're just saying is that an election or an appointment of a specific person doesn't create a moment where we say, hey, let's make a change to your portfolio. So I think that brings us to the conclusion. I know we're almost a half an hour in. So if you guys have questions, Gene, Millie, myself, the team are standing by and we're ready to answer any. Millie, do you want to unmute and let us know if there's any questions here?
Can you hear me now?
I can hear you, yep.
Yeah, thank you. We don't have any questions so far.
All right.
Clayton, this is Gene. I've been getting some questions on inflation and you touched on it briefly. You want to expound on that a bit?
Yeah, absolutely. I got a call today about inflation actually. So there's quite a few articles out there actually talking about inflation right now. And the concern is there going to be any inflation? Because really the last 12 to 15 years, inflation's been really low. We've talked about that in the investment committee, and I kind of mentioned on the slide, our take is that inflation is likely to stay low for a while. But it's something that we really are keeping our eyes on pretty closely. So just to talk about kind of some of the mechanics from an economic perspective on how inflation kicks in. Normally, what you would see is in periods of low unemployment, which we just had, at the beginning of this year, we were at about a 3% unemployment rate. So in periods of low unemployment, you oftentimes experience wage growth because companies are having to compete for their labor a little harder, and therefore they have to pay their labor a little more, which creates wage growth. And wage growth, normally happens, we're expecting more wage growth, I guess, than what we got is probably the best way to say it. So at the beginning of the year, unemployment was way down and wage growth had started to creep in. But normally you'd see inflation follow wage growth, and we haven't seen that. And that trend really hasn't taken place even in the last 12 years. And there was a ton of discussion around that in 2008 to 2010, 2012. The Fed had similar policies as it has right now. It was pumping lots of money into the economy, just like it is now. It's really pulled on every tool in its toolbox, and it's doing everything it can to keep the economy moving. We had a massive stimulus bill. So there's been a lot of cash that's been infused into the economy. But right now, just like in 2008 to 2010, inflation has remained muted. So you go back and look, there's a lot of articles that talk about, hey, is it going to go up? And right now, we're not seeing the indicators that inflation is going to kick in or be really high, but it's certainly something we watch every single month as the numbers come out and keep tabs on. So.
Clayton, we have another question. What are the riots and the inability of some state and local governments to control them doing to the overall economy?
Say that one more time, Millie.
What are the riots and the inability of some state and local governments to control them doing to the overall economy?
The economy, well, it's probably a good point to make that the economy and the stock market are two different things. So, the stock market moves in directions that, isn't necessarily directly correlated to the economy. So certainly there's a lot of municipalities, cities and counties and areas in various states, even states that are not just having issues with these riots, but are actually having issues economically because their revenues have been hit significantly because of this downturn. So That plays into some fixed income decisions, and some, muni bonds and stuff are tied to municipalities and their ability to make sure that the revenues are coming in. And so, as far as, so I think you got to separate economy and stock market. What it's doing to economies is certainly creating problems for, cities and counties and states and government across the country. And some are in better or worse shape than others. A lot of what you'll read is that the municipalities that have had big programs and have big pensions and a lot of obligations to fulfill are really hurting. Those tend to be more in Democratic controlled states. So that was kind of a big sticking point actually in this recent stimulus bill too, if some of you might remember, because the Democrats wanted more money to help bail out these states that were really underwater, and cities and states that are really underwater. And Republicans weren't as excited to put that in the bill. So just a lot of different sticking points. So yeah, I mean, it's certainly impacting those local places from an economic standpoint. From a stock market standpoint, a lot of our portfolios we've got small cap, we've got mid cap exposures, which that's what a lot of these economies are, or the smaller cities and stuff are impacting small businesses in the area. But in general, I mean, a lot of what's driving the market up are these really big companies, the Amazons, the Apples, and the riots aren't really impacting Amazon's ability to sell something online. So I think, where your portfolio is positioned versus, where a riot's taking place can be very different. And there's not any big things that we're doing to be able, to necessarily make a change based on a local riot, but it certainly is something we're watching. I think for anyone with munis, as you move forward, that's what we do often. We're looking at picking up a municipal bond fund. Is we don't want to, like, you might remember Puerto Rico was in pretty rough straits there a while ago, so weren't really picking up a lot of Puerto Rican bonds after that. So.
All right, Clayton, we have another question. Is the 2% target for inflation realistic? I think there is a meeting tomorrow. What do you predict will happen?
Great question. That's the Fed target, 2% inflation. It probably, I think that's a target, remember? So I think that's what they're trying to work towards. So is it realistic? Can they get us to 2% inflation? That's probably a question mark given everything that's going on. And oftentimes it's, it takes more than just the Fed taking action to be able to get the economy and moving and inflation moving too. So, so I don't know what will happen tomorrow. I don't anticipate them making any big changes as far as, I think it's going to be very much an economic update from them. I think they'll probably point out some places that we're having some economic strength. Unemployment rate came down. We had a bad jobs report a week or so ago. But I think they'll point to the fact that they're going to be looking at economic indicators as their litmus test to make changes and make decisions. And most likely they'll say they're going to hold rates where they're at, and we'll just kind of keep we'll keep watching things. So.
This is Gene. I know we had a question earlier about, in this low interest rate environment, what are we doing? And the answer is pretty simple. We're being very patient. Clayton referenced it earlier that we're favoring quality over return. And it just doesn't make sense, as we've referenced in previous talks, to go out and buy bonds that are just giving us pitiful yields. At some point, which bears the inflation label, we'll have an increase in interest rates. But in the meantime, we are being very patient because we don't want to go chase high yield at the expense of poor quality. So we're being patient.
All right, any other questions tonight?
I've just got one comment. Millie and Clayton, y'all did a great job. Well done.
Thank you, Jean.
Thank you, guys. We appreciate you joining us. And this will be recorded and put on YouTube as normal. So if you've got friends, family, anyone that this would be helpful for, please make sure you just let them know. And also here at the office, we're always there for phone calls and emails from you, and then as clients and friends. Please send them our way if you've got anyone that's just got anything that they need us to kind of help them with. So again, appreciate all of you and all your time, and thank you for listening tonight.